When geopolitical conflicts in the Middle East escalate into active military strikes, the physical damage immediately disrupts the global supply chain. A destroyed tanker represents a sudden drop in available petroleum. That immediate scarcity ripples outward, forcing a sharp increase in global energy costs for every nation reliant on imported fuel. This chart tracks Brent crude. Watch the market react to supply disruptions, pushing prices past $100 per barrel. This shock inversely affected the Indian rupee. As oil peaks, the exchange rate collapses, plunging to a record low of 96.58 against the dollar. This was a mass capital flight. Investors liquidated their positions and pulled 2.6 lakh crore rupees out of the Indian economy in just a few months. During times of global panic, international investors instinctively move their capital into the ultimate safe haven asset, United States dollars. India is uniquely vulnerable to this trend. The country imports 70% of its crude oil, settled in dollars, meaning higher prices force the nation to burn through its currency reserves. This dependency is built into the global financial system, where decades-old agreements ensure that international commodities and trade remain tethered to the American dollar. Consequently, foreign portfolio investors, institutions managing capital across borders, rapidly sell off their Indian equities to retreat to the perceived safety of U.S. markets. India was caught in a structural trap. Global fear artificially inflated the value of the dollar, punishing the rupee despite the country's internal economic stability. To defend a falling currency, central banks like the Reserve Bank of India typically use one primary weapon: raising interest rates. However, raising rates makes domestic borrowing expensive. This move directly restricts business expansion and can halt a nation's overall economic growth. This created a difficult choice. The RBI had to decide between defending the rupee at 96.58 or protecting India's projected 6.6. Simultaneously, they opened long-term government securities to foreign investors by removing previous investment limits on 30- and 40-year sovereign bonds. This chart tracks the result. These alternative measures generated an immediate leap in capital, pushing India's total reserves to the $676 billion level. The RBI successfully engineered a targeted capital injection. They fortified the rupee from the outside, entirely bypassing the need to raise domestic interest rates. By July 2026, the global markets began to respond to the Reserve Bank's unconventional liquidity defense. Foreign investor behavior reversed dramatically. Sell-offs halted as over 15,000 crore rupees flowed back into Indian equities in a single month. This returning capital relieved the pressure on the currency. The rupee moved away from the 96.58 peak, eventually stabilizing at 95.72 against the dollar. This recovery was supported by strong domestic metrics: a current account surplus, steady remittance inflows, and active merchandise and service exports. The July recovery proves the spring crash was driven by external geopolitical panic, rather than any underlying weakness in India's actual economy. Following the stabilization, the Reserve Bank governor provided an assessment of the currency's true standing on the global stage. He noted that when measured by the real effective exchange rate, which weighs the currency against several trading partners, the Indian rupee is currently undervalued. Comparing the rupee exclusively against a US dollar inflated by global conflict creates a false illusion of national economic failure. India maintained its 6.6% growth and $676 billion reserve, while other emerging markets suffered severe damage during the crisis. In the face of global financial volatility, India survived the shock. The RBI demonstrated how to shield a currency without sacrificing a nation's future.